Welcome to Iron Financial, the place where we forge stronger portfolios by cutting right through all the market weakness. Now, on the surface, Comcast's latest earnings report, it looked like a brand new skyscraper. Seriously, the headlines were glowing, the stock absolutely popped, and Wall Street was applauding. But you know what we do here? We are the structural engineers of the market. We don't just stand back and admire the pretty architecture. No, we grab our hard hats, we get our tools, and we stress test the very foundation. And today, we're taking those tools to Comcast's Q1 2026 results. We are here to answer one absolutely critical question. Is this company a solid build, or is it just a beautiful facade hiding some really serious underlying structural problems? All right, let's get to work.
Okay, so let's just dive right into this. The initial reaction from the market was frankly explosive. The very moment these numbers hit the wire, the stock just surged, up 6.7%. Now, when you see a jump like that in a mega cap company like Comcast, it tells you one thing loud and clear. They didn't just meet expectations, they completely crushed them. The traders, the algorithms, they all saw a big, juicy revenue beat, and they slammed the buy button. It's as simple as that. And you know, this is like the gleaming front door of the earnings report, right? It's designed to impress absolutely everyone who walks by. And for a day, you have to admit, it definitely worked.
And right on cue, almost as if it was scripted, you get this statement from the very top. The co-CEOs Brian Roberts and Mike Cavanaugh, they come out with this line, "We're seeing tangible early signs our pivot is taking hold." This is pure management narrative. They're projecting strength. They're projecting control over their grand strategic direction. But let's pump the brakes for a second. Every single earnings report has language just like this. So we have to ask, is this a genuine, honest assessment of a successful strategic shift, or is it just the necessary corporate positioning to keep the story positive? Tangible signs. That is a bold claim, and our job today is to verify if those signs are truly concrete or if they're just a mirage in the desert.
And that really is the entire mission here today, isn't it? The market saw that fresh coat of paint, and they absolutely fell in love with the color. But we need to know what's underneath, because that is how you separate a real, solid investment from a value trap that's just waiting to crumble under its own weight. We are going to stress test these numbers, we're going to kick the tires, we're going to find out if that foundation is truly solid or if it's built on sand. So, here's our inspection plan for today. First, we are going to look at the headline beat. You know, the big, splashy numbers that got everyone so excited? Then we'll start unpacking the numbers, going way beyond the surface level stuff. After that, we are going to examine the two main pillars of this entire company, what we are calling the connectivity conundrum and then the content and experiences story. Next, we are going to check the plumbing with the dividend and cash flow. And finally, we will deliver the one and only Iron Financial verdict. Let's get right into it.
All right, let's start with the blueprints that the market saw first. Section 1, the headline beat. These are the top-line figures that were plastered all over the financial news networks. The exact numbers that fueled that initial 6.7% stock pop. And you know what? On the surface, it looks like a completely flawless victory. And this table just brilliantly illustrates why the algorithms and the headline readers went crazy for this report. It was a clean sweep across the board. Revenue came in hot at $31.46 billion. That's a full $1 billion over what the analysts on Wall Street were expecting. Adjusted earnings per share, that hit 79 cents, beating the 73-cent estimate pretty handily. And adjusted EBITDA, which is a really key measure of a company's core operational profitability, that also came in strong at $7.93 billion versus the $7.74 billion expected. A beat, and another beat. From this perspective, from this one slide, it looks like an incredibly well-constructed quarter. There's not a single crack in sight.
All right, so that was the shiny brochure. But you and I know we do not buy a building based on a glossy brochure. Now it's time to put on the hard hat, grab the heavy-duty flashlights, and head down into the basement. Welcome to Section 2, Unpacking the Numbers. You see, a headline beat is nice, it feels good, but it tells you absolutely nothing about the real structural integrity of the business. It is time to start looking for the cracks.
Now, what's really interesting here is the pro forma revenue. For those who don't know, that's a metric that adjusts the numbers to give us a much better apples-to-apples comparison over time, factoring out things like acquisitions or divestitures. And what did it do? It grew a massive 10.9% year over year. That's an increase from $28.4 billion all the way up to nearly $31.5 billion. In this current economic environment, for a company of this scale, hitting double-digit revenue growth is some serious heavy lifting. This is the gleaming facade of the building, and you have to admit, it is undeniably impressive.
But, and this is a huge but, what happens when you look past that beautiful facade to what the business actually kept as profit? Well, the foundation isn't just cracking here, it is actively sinking. Net income absolutely plummeted, going from $3.4 billion just a year ago to a measly $2.2 billion this quarter. That is a 35.6% year-over-year collapse. This right here, this is the first major screaming red flag. There's an old saying on the street, revenue is vanity, profit is sanity. And right now, the profit picture for Comcast is looking completely unhinged. This is the exact point where that story of strength begins to completely fall apart, and it falls apart fast.
And the most crucial point is staring us right in the face on this slide. We put all the key metrics together, side by side, and the picture becomes alarmingly clear. The only green arrow on the entire board is that pro forma revenue growth. Every other single critical measure of profitability and financial health is deep in the red. Adjusted EBITDA is down almost 17%. Net income, as we just saw, collapsed by over 35%. Adjusted EPS down over 27%. And maybe the most critical of all, free cash flow is down a shocking 28%. The engine is running faster, for sure, but is leaking oil and burning cash at an absolutely alarming rate.
Okay, so now let's inspect the first major structural pillar of this company. Section 3, the connectivity conundrum. This is Comcast's traditional foundation. We're talking about the broadband and cable business. For decades, this was the absolute bedrock of the company, a seemingly unshakable, unstoppable cash flow machine. But the question we have to ask in today's modern media landscape is this: is that bedrock starting to turn into quicksand?
While the numbers for the segment itself tell a story of a slow, steady decay, total revenue for connectivity and platforms, it actually shrank by 1%. The profits from this segment, the adjusted EBITDA, they fell even faster, down 4.3%. And what that means, if you connect the dots, is that the margins are getting squeezed. They're contracting by a pretty significant 140 basis points. For those of you keeping score at home, that's a full 1.4 percentage points of profitability just vanishing. When the core of your business is shrinking in revenue, profits, and profitability all at the same time, you have a very serious problem. This pillar is under intense pressure from all sides. So let's pinpoint the issue. Let's get right to the heart of it. Here is the primary crack in that foundation: a loss of 65,000 domestic broadband customers in a single quarter. This is the core product, and it is leaking subscribers. However, to be fair, management isn't just standing by and watching this happen. They are actively trying to reinforce the structure with a major push into wireless. And you have to give them credit. They added a record 435,000 wireless lines. That's a huge number. This brings them to 9.7 million total lines, which means about 16% of their broadband customers now also take their wireless service. So this is the central battle right here. You have erosion in the main foundation, but they're quickly building this new, potentially strong reinforcement. The critical question for the long-term stability of the company is this: is that wireless growth a strong enough patch to offset the accelerating decay of the legacy broadband business? Right now, it is a race against time. Now, let's move to the second major pillar, the one Comcast is really betting its entire future on. Section 4, the content and experiences story. This is NBC Universal, we're talking the movie studios, the theme parks, and of course, the Peacock streaming service. This is supposed to be the new, modern skyscraper being built on top of that old foundation. But we have to ask the hard question: is this growth a permanent structural improvement, or is it just some temporary scaffolding that looks really impressive from a distance but could be taken down in a single day? Just look at this number. I mean, really look at it. This is the figure that drove all the headlines. The media segment revenue grew by an absolutely staggering 60.8% year over year. When a company this large posts a growth number like that in any of its major segments, you better believe the market takes notice. This appears to be a steel and glass tower of growth, just soaring into the sky. It is an incredible performance on its face. But hold on. Before we go and declare this the eighth wonder of the world, we have to look at what's actually fueling that rocket ship. The company itself called it a legendary February, and for very good reason. This one single quarter contained two of the biggest media events on the entire planet: the Milan Cortina Winter Olympics and Super Bowl LX. These are massive, one-time injections of advertising and distribution revenue. They are not part of the normal, repeatable underlying business. They are temporary, one-off events. So let's do the math, and we can do it right from their own press release. Total media revenue was just under $7.3 billion. Okay, now let's remove that temporary scaffolding. We subtract the $1.42 billion that came from the Olympics, then we subtract another $758 million from the Super Bowl. These are just enormous sums of money. So once you strip them away, what is the actual underlying revenue of the core media business?
Well, the answer is $5.1 billion. And when you compare that number to the prior year, the real organic underlying growth rate is 12.7%. Now, let's be crystal clear about something. 12.7% growth is still very strong. That is a solid, respectable number for a media business, no doubt about it. But, and it's a big but, it is not the spectacular, mind-blowing 60.8% that the headlines were screaming about. This is the critical difference between the facade and the actual structure. The structure is solid, but it is not the magnificent skyscraper the exterior suggests.
Now, let's break down the rest of this segment because there are some genuinely strong parts and some really deeply concerning ones. The theme parks are an absolute fortress of strength. EBITDA up 33% to $551 million. That's a real, durable, cash-generating pillar, no question. Then you have Peacock, and on the surface, the growth numbers look fantastic. Subscribers are up 12% to 46 million. Revenue is up an incredible 71%. But this growth is being bought at a staggering price. The adjusted EBITDA loss for Peacock more than doubled. It ballooned from a $215 million loss a year ago to a $432 million loss today. They are literally lighting money on fire to get those subscribers and that revenue. It's a growth engine, yes, but it's an incredibly expensive and inefficient one at this stage.
And that brings us to the plumbing of the entire operation. Section 5, the dividend and cash flow. You know, for many investors, especially income investors, this is the only thing that really matters. A company can talk about pivots and synergies and strategies all day long, but if it can't generate cold, hard cash to return to its owners, it's all just noise. So the question is simple. Can Comcast continue to support its dividend, which is a key pillar of this stock's entire value proposition?
Well, management made a very clear statement of confidence. They held the dividend steady at $1.32 per share on an annualized basis. This is the board of directors telling the market loud and clear. We are confident in our financial position, we believe in the future cash flows of this business, and we are committed to returning capital to you, the shareholder. For income-oriented investors, this was a collective sigh of relief.
But here is the massive, jarring disconnect. The dividend is a promise, but free cash flow, that's the reality. And the reality is brutal. Free cash flow, that's the money left over after all the expenses and capital investments, the money that's actually used to pay dividends and buy back stock. It absolutely plummeted. It fell from over $5.4 billion in the first quarter of last year to just $3.9 billion this quarter. That is a 28% year-over-year collapse. The well that provides the water for that dividend is starting to run dangerously dry.
And this brings us to what might be the most urgent question of this entire analysis. In this quarter alone, Comcast returned $2.5 billion to shareholders through that dividend and through stock buybacks. Yet, the cash engine that is supposed to power those returns just took a 28% nosedive. How long can you possibly maintain that level of payout when your ability to generate actual cash is deteriorating so rapidly? This isn't just a small leak, people. This is a major pipe bursting in the financial foundation of the company. It is a massive warning sign about the structural integrity of that dividend.
So let's bring it all together. We've examined the headlines, we've dug deep into the numbers, we've inspected the core pillars of connectivity and content, and we've checked the all-important cash flow plumbing. It is finally time to step back, to look at the entire structure, and deliver the final iron financial verdict.
All right, let's lay out the bull case one more time. They absolutely blew past revenue expectations, which is no small feat in this economy. They delivered record wireless additions, showing that their strategic pivot has some real teeth. The theme parks are a cash-generating monster, growing at an incredible clip. Peacock's top-line growth in both users and revenue is undeniably impressive. And of course, management is projecting total confidence with that steady dividend. But every single one of those bull points is countered by a deep, undeniable crack in the foundation. Profits and margins are collapsing across the entire enterprise. The core business that built the company, Broadband, is actively shrinking. Free cash flow, the ultimate measure of financial health, fell off a cliff, down 28%. That spectacular media growth was artificially inflated by one-time events, and Peacock's growth is coming at the cost of massive, accelerating losses. The entire structure is under immense strain.
So the verdict from Iron Financial is clear. Comcast's Q1 results are a classic facade. The exterior, beautifully painted with a massive revenue beat and supercharged by temporary events like the Olympics and the Super Bowl, it looks incredibly strong and impressive to the casual observer. But when you conduct a thorough inspection, when you really look past that fresh coat of paint, you find that the core profitability, the foundational broadband business, and the all-important cash flow are all showing significant, undeniable structural weakness. This is a company with a gleaming top line but a rapidly deteriorating bottom line. For investors who only read the headlines, this looks like a solid buy. But for those of us who inspect the foundation, it looks like a potential trap. The structure is just not nearly as solid as the facade suggests.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.